Hello, good morning or afternoon or evening, wherever you are. Welcome to the third in our series of Lacima webinars run by EEX. So we're very happy that EEX have invited us to run this series of seminars and work in this forum. I know that some of you have attended the first two already, so this is the third in our series, and this one is very timely from some of the graphs that we'll show later, and it looks at profiting and managing risk from spreads between European gas hubs. So the usual disclaimer up front about what we're going to say here and the reliance that you can or can't take from a sort of trading perspective. Okay, so let's get into today's presenters. So those of you that have attended the first two webinars, you'll see myself and Martin Ogden. We've talked through the first two, and we have an extra presenter this time, Ying Zhong. So my name is Chris Strickland. I'm one of the founders of Lacima, head up the sales team here in Sydney. Martin Ogden is our go-to person, anything from a sort of trading and LNG perspective. Martin used to work in the gas and LNG market, so he gives us a very unique perspective from that perspective. And then Ying is part of our technical sales team. Ying does a lot of the background work to set up these examples, and he's going to be talking through one of the examples that we've got today. So that's us as presenters. For those of you that are new to Lacima, just very quickly on this slide and on the next slide, Lacima is an energy analytics company. We are, since the beginning of the year, we've been owned by EEX. That's why we're part of the EEX webinar series. And our vision and mission statement is to empower confident decision making for energy and commodity market participants through superior innovative analytics and insights. So those could be traders, they could be utilities, we could be talking to front office, middle office, treasury, and what we try and do with our analytics is to be able to provide key insights in the areas of valuation and risk management. So one more slide on Lacima before we start. So we're a energy analytics company. We have a series of models, calibration routines, simulation engines, optimization engines, which are used across the various energy and commodities. So our clients trade power, gas as part of that, LNG, oil and products. In the power space, we do a lot of work around wind, solar and hydro assets, as well as the thermal, sort of the more old-fashioned thermal assets. We also have agricultural and metals clients. And we provide solutions to them that allow them to both understand the value and risk sensitivities of different types of trades, like the ones we're going to look at today that they have in their portfolio, and also to be able to risk manage those trades through time. So you can think of the two boxes that I have up here. On the left-hand side, Lacima Trader is predominantly as an Excel interface to our analytic engines, which is predominantly aimed for sort of upfront, potentially ad hoc deal analysis and insights into the value of different trades. So our first webinar and this webinar are essentially based on that. And then on the right-hand side, we offer solutions which are really aimed at portfolio level calculations. So once you've done this pre-deal analysis, you've done the trades, they're in your portfolio. Now to understand the sort of the change in mark-to-market, P&L attribution, market risk metrics like value at risk, gross margin at risk, earnings at risk, or the more cash flow based metrics, or PFE on the credit side, stress testing, scenario analysis, all the things that risk groups like to be able to run to both understand the levels of the numbers, how they're changing, and what they're sensitive to. And if we were to run last year's weather scenarios through today's portfolio, how would it react? Within that application as well is the analysis that we did in the last webinar, which is on LNG. So structuring LNG deals, looking at LNG deals and hedges as part of a wider portfolio analysis. Okay, so just in case you missed the first couple of webinars, so the first one, which we ran in about a month ago, we looked at gas swing contracts, take or pay contracts in the European market context. I've just realised there's a typo in this box here. I stole this from the EEX website, so it's wrong on the EEX website, Lucas. That obviously happened in the past, but you can watch the recording on EEX TV. So if you go to YouTube and search EEX TV, then all the prior webinars are up there, and this one will be up there as well. That was the first in the series. Have a look at that. It's very much related to what we're talking about today, gas contracts in European markets, and how the sort of current situation in Europe allows people to be able to profit from that and get exposed to risks, so how to risk manage that. The second webinar that we ran 2 weeks ago was a difficult time for European market participants because it was really aimed at the sort of Asian LNG markets. But again, that's on EEX TV. That was to try and understanding the value of the flexibility in structured LNG trades. The flexibility to divert cargoes, cancel cargoes, swing between some minimum and maximum, choose between different pricing bases. We looked at the valuation of some strips of structured trades and teased out the value of the different flexibility and looked at the Greeks and how to monetize those deals and all that kind of stuff. This one then is profiting from the spreads between European gas hubs. In a couple of days' time, the marketing and communications group at EEX will upload this to EEX TV as well. And then just as a quick flag for an upcoming one. So this is not until next year. So today's does feel like a bit of a end of term party webinar because we're taking a break until February. But the webinar in February is going to be a more sort of portfolio level calculation, looking at if you've got a portfolio of power and gas trades, trade on EEX, you've got a portfolio of European power trades and gas trades. How do you measure the risk in portfolios of those? You've got futures, swaps, options, spread options. How can you understand the current level of risk in the portfolio, and out of all the things that you trade, where are the hot spots? How is it changing from one day to the next? Really trying to dig down underneath the headline numbers to gain insights into what's driving it and how it's changing. So that'll be the last of this 4 series of webinars in early next year. Okay, so I'll hand over now to Martin. Martin is going to give some of the sort of current and over the last few months market backgrounds which are leading to the reason why people are interested in these types of spread trades that we go on to analyse in the rest of the session. So Martin, over to you.
Thank you, Chris. All right, so I'm going to run through the market background, kind of what's going on in the markets, and then we're going to run through a couple of deals that are typically traded and work out the main parameters around those, how they're valued, and the various outputs you can look at to gain insights into those deals. So starting off with the market, what's been going on recently? So as you guys are all probably aware, there's been a lot of volatility, very high prices. We had the shutdown into COVID. Then we've had a series of supply shocks through Europe. We've had the reopening post-COVID. We've had a big push to get gas into storage in Europe, followed by storage assets being too full in Europe. And we've had a lot of pull from the issues around the war in Ukraine. So in short, there has been an awful lot going on in Europe. And where are we now? We're looking at a situation where German storage, which is one of the main kind of storage holders in Europe, is almost completely full. Storage levels over the whole of Europe are over 95% full, so extremely high by historic standards. We're looking at the EU introducing various caps and price controls. We're looking at issues around war risk, so whether or not the issues in Ukraine are going to stay where they are and perpetuate on an ongoing basis, whether things are going to ease off or whether they're going to escalate. So there's a lot of different risks in there, and the dynamics of them can affect the markets in different ways. Issues around infrastructure. So we had an incident around the Nord Stream 1 and Nord Stream 2 pipelines, various outages on pipelines through Europe, and ongoing risks flagged on other key pipelines, and weather risk. So that used to be kind of in winter, whether it's cold, in summer, whether it's hot. Now with this big dominance of renewables in Europe, we're also looking at, how windy it is and how sunny it is, and that can have a very major effect on prices. So bringing this back to today's discussion, we're really looking at pipelines. Now, pipelines are really driven by the value between different markets. And here we have a chart where we're looking at the 5 main gas price hubs in Europe, so in Northern Europe. So we have the UK, the Netherlands, Germany, Belgium and France all shown here. Now you'll see this period this is over the last year, and you'll see the period September 2021 to March 2022. Now prices were very volatile and high during that period. You can see prices historically are usually around the 20 to 30 euros a megawatt hour level, and in this period they're 50 euros a megawatt hour all the way up to 200 euros a megawatt hour, so really large volatile prices. But the key thing to note is that the markets were still relatively well coupled. There were a few periods where they disconnected a little bit, but largely they were staying really coupled together. So the key question is, what happened? Why did they start decoupling? That really started around March, April of this year, where we started to see really the high prices in Europe attracting a lot of LNG. Now in Europe's LNG import capacity, a lot of the spare capacity is in the UK. So we have really high demand coming from mainly Eastern Europe, around Germany, where there's issues around Russian flows and reductions in gas coming from Russia. So they're the ones that are wanting the gas, but the people with the capacity to take the gas is Britain, it's the UK. Now the UK is shown in this chart with the light blue line, and you'll notice that it dropped really substantially. Why was that? So there's 3 factors that are going on here. The first factor is the UK has this extra capacity to take LNG. So very high prices in Europe, lots of LNG coming to Europe. That gas is unloading in the UK. So the UK has lots of gas. Now what? Second factor is storage. So the UK has very little what we call seasonal storage. So seasonal storage are very large fields that take a long time to fill. They're usually old gas fields, and they're used to meet peak winter demand. The UK does not really have any of those. It had a very large facility called Rough that closed several years ago. So as a result, this excess gas didn't have anywhere to go. There's no big storage to put it in. And the third factor is interconnection, exporting the gas away from the UK into Europe. So the UK does have a pretty decent size export pipeline, but that pipeline quickly maxed out. It wasn't able to take that additional gas. So what we saw as a result of all that was that the UK price disconnected, and we saw this massive divergence from the UK to the European markets, which has not been seen before. What else was going on? So the orange line that you'll see there, that you can see there, is Germany. And as we were going through the summer, there were a series of curtailments of Russian supplies into Europe. So it wasn't a single reduction in gas, it was many reductions in gas over a series of time. And at the same time, Europe had a requirement to be pretty full, nearly full by the time of storage by the time we reached winter. So you have storage holders in Europe being told that they have to fill up gas, and at the same time you're seeing supplies dropping, and they're doing so in this kind of incremental way with a lot of uncertainty around them. So lots of uncertainty, and that just pumped prices up. So you can see that the German prices there, which are shown in the orange line, really jumped up. The other two lines in this picture are the French price, PEG, and the Belgian price, Zeebrugge. And you'll notice that those two really just bounce between the other two markets. So sometimes PEG is jumping up so that it's at a similar price to the German price, and Zeebrugge is kind of moving in between the two. So those two are kind of balancing markets between the two. As they need to pull gas, the prices are moving so that the gas knows where to flow. Now, any gas trader will tell you that these prices were pretty extreme, and as a result of which, there's a lot of opportunity to make money from transport capacity in Europe. So let's talk about, what that means for the current trading environment. So any trader will tell you that high volatility means a lot of risk and a lot of reward. It's what traders kind of get out of bed for. It's the opportunity to make some money and to make large amounts of money, but it also stands a lot of risk. What kind of things do well in this current environment where you've got a lot of volatility? Well, it's really any flexible assets. So in this webinar series, we've been going through these assets one by one, and each of them has benefited in different ways from the high volatility that we've seen in the market. And how do transport deals do? Well, they profit from changes in the fundamentals between markets. So usually when you're talking about pipelines, you'll be looking at one market and you'll be saying, next week it's going to be really cold, or there's going to be a whole load of assets on maintenance. Therefore, we think prices are going to be a bit higher, and we're going to take gas from one market, ship it to another market, and that's kind of where you make your profits. Now we've seen this massive kind of dislocation between the markets. It's being driven by those same fundamentals, but what we have going on now are what we call constraints, a hitting of constraints. So markets behave pretty well when they don't hit constraints, but as soon as they get to constraints, things get really interesting. What do I mean by constraints? That's where something gets too full. So where you've got an interconnector and that interconnector reaches capacity, or you've got a storage asset and a storage asset reaches capacity. Once these sources of flexibility reach their capacities, prices can really move around a lot. So now traders are looking at the fundamentals, kind of what's going on day to day, but they're really focusing on where are these pinch points between the markets? How likely are those pinch points going to cause extreme price movements? Is the storage in Germany completely full? What happens when it becomes completely full, etc. Now, when we're looking at valuing a transport deal, it breaks down to a few components. We're going from hub A to hub B. Our revenue is in hub B. So let's say that we're going from Zeebrugge to PEG. So we're going from Belgium to France. We will make our revenue, which is the value of the French gas. We will pay the cost, which is the value of the Belgian gas. We'll also pay transport costs, which is the cost of shipping it from Belgium to France. And then another key component which has been coming into transport contracts is a contractual usage cost. So that's part of the contract structure where you pay the person that is selling you the contract a fee each time that you want to use the contract. So those are the main components that go into what we call the payoff function, the thing that drives profit of the transportation deal. And that's what we use to work out the economics and value of the deal. Okay, transport, where are we going to transport? We'll transport wherever price differentials can make us some profit. So that's essentially where the value of shipping the gas from one point to the other is higher than the costs of shipping the gas. And we're looking to capture those days on which hub prices are significantly different. Motivation. So a lot of people think of transport deals purely on what we call a merchant basis, which is looking at the deal on its own. There's been a big shift to companies looking at things on a portfolio basis. So you'll be looking at your transport asset not only on its own, does it make money on its own, but does it add value to a portfolio? Does it add insurance to a portfolio? So if I'm a French power producer using gas to produce power, if I've got a lot of pipeline capacity, that might mean that I can buy gas from other markets at cheaper prices and insulate myself partly from jumps in the French gas price. So we now have companies looking at these more portfolio plays, and they're more interested in seeing how does the pipeline fit into the wider portfolio context. Just quickly looking at the market background. So these spreads are really driven by how well connected the markets are. What we have here is the spread between Germany and the Netherlands. So Germany and the Netherlands are very well connected. They have similar sources of gas, similar entry points. And you can see here they're moving between plus or minus €1 a megawatt hour. So that's pretty tight, and that's over the entire period. So here is these are the items that I pointed out earlier. That's the point at which we have large amounts of gas landing in the UK. This is the point at which Gazprom starts curbing supply on Nord Stream, one of the connection points from Russia to Europe. And this is kind of the incremental increases we were seeing, very large spike in prices over Europe. You'll see that none of those really had an effect on the spread between Germany and the Netherlands. Now, if we look at a different point, this is Germany and the UK. Here is the point at which the UK started to receive large amounts of LNG. Here's the point at which we started seeing Russia reducing supplies into Europe, and that's the kind of ramp up that we saw through the summer as we were desperately trying to fill European storage. These markets were pretty disconnected. They're further apart, so they're not immediate neighbours to each other, and the pipelines between them are a lot more limited. So it all comes down really, if you're looking at the extreme price moves, to where the constraints are, where the pipelines can become completely full. All right, now I will pass to Ying. Ying's going to run through a standard, what we call A to B type deal, which is looking at the value of moving gas from one market through to another.
Thanks very much, Martin. So in my section, I'll go through the standard A to B type of transport deal. And as Martin said, the buyer has the option to take natural gas from one market to another via the pipelines. So in this particular example, the gas being transmitted is from Belgium to France. And the relevant markets that we're looking at are Z and PEG, where the buyer takes Z and receives PEG. And we also assume a transport and usage cost of €550. So usually the buyer will have to account for these transportation costs, which include fees such as system entry, exit fees, pipe transmission fees, and other variable usage costs. So the duration of the deal is 1 year from October 22 to September 23, where the buyer has the option to move the gas daily. And given these terms, the payoff is described in the bottom. So it's very similar to that of a call option, where the buyer exercises if the spread is favorable after accounting for the transport costs. So as an example, if PEG is trading at 200 euros, Z at 190 euros, and the transport and usage cost at 550 euros, then the payoff would be 450 euros. So we will run the analysis on the valuation date, which is September 1st, and we will be using all the available marketing information up until that point. Next slide, please, Chris. Thank you. So on the left-hand side is the historical prices of PEG and Z in euros per megawatt hours. And this historical data spans from September 21 to end of August 22, just before the valuation date. And on the right-hand side is their spread, which is calculated by taking the difference between the two curves. And we can see from both charts that the PEG and Z spread has historically been quite tight before March. And we see occasional jumps between 5 and 6 euros per megawatt hours. But since March, we noticed that due to the market conditions, the spread has widened and fluctuated significantly. And this increase in volatility is actually great for deal buyers who actually have the capacity to transport gas between the two markets. This allows them to capture the spreads in their favor. And so in the next section of the analysis, we have used 5 years of historical data to calibrate our models. So this affects parameters such as correlation and volatility. But in practice, the period and duration of historical data can often depend on the practitioner's market view. So a more volatile outlook may prompt them to use more recent data, whereas a longer term deal may warrant a longer calibration period and vice versa. So we'll look at two different methods of modeling the spread. One where we simulate the underlying PEG and Z prices and then implying the spread by taking their difference. And the other method is where we simulate the spread directly. So in the charts, so we'll look at the implied spread method first. So on the left-hand side, we have the PEG and Z future curves that are observed on the valuation date, which is September 1st, 2022. So these curves span the entire duration of the deal for 1 year from October 22 to September 23. So this is the market view that our simulations are based on. And using the historically calibrated model parameters from the previous slide, we simulate the spot price evolutions for PEG and Z. And for this example, we ran 1,000 simulations, and the charts on the right, so the top and the bottom, are the simulations numbers 1 to 3 of the simulated PEG and Z curve prices through the deal period. And all that's left to do is to create the implied spread curve by taking the difference between each pair of these curves. So on the next slide, on the top right, this is the result of the implied curve generated from the previous slide. And so these are the implied PEG and Z spreads. And so note that these curves are relatively flat and do not exhibit as much spot volatility and fluctuations as seen in our historical spread. So I guess we will consider a second method where we model the spread directly. So assuming a normal distribution on the left-hand side of the charts, we are looking at the spread between the forward spread between PEG and Z derived from taking the difference of the forward curves on the previous slide. So we assume a normal distribution for the spread, and we use the historical data to calibrate our model parameters to simulate the forward spread. And so the results are shown in the bottom right chart. And again, this is the simulation results showing that this direct spread model captures the spot volatility much better than the implied spread model at the top. And another advantage is the direct spread model is also less likely than the implied model to experience drastically increases in the spread over time. So we are less likely to see significant blowouts of the risk factor. And so given these advantages, we decide to use the direct spread model in our analysis. But in practice, this decision can depend on many factors, such as the practitioner views, the market conditions, and the deal structure itself. So on the next slide, we are looking at the outputs of the deal. So using the direct spread model, we ran 1,000 simulations, and we first look at the intrinsic and extrinsic values of the deal. So the intrinsic value is the value of the deal if we were to exercise all the options on the valuation date. And so in the top chart, we have the implied forward curve on September 1st. And while the deal is in the money, the spread will trade above the transport and usage cost. And that's reflected in the months of October, November, and December. So during these months, they are intrinsically in the money given the initial forward curve. And these are represented by the blue areas of the column charts below. And the next value we're looking at is the extrinsic value, which is any additional value that exceeds the intrinsic value. So the sources of extrinsic values come from embedded optionality in our transport deal. So these optionalities allow the holder to exercise whenever the price or the spread moves in their favor. So the simulations show that the extrinsic value of this deal is about 170 euros, which is almost 33% of the total value. So it can be very valuable to be able to capture these extrinsic values because they are worth a lot more in volatile market conditions, and they are often very difficult to measure due to the complexity of the deals, giving market participants who can a significant edge over others. So in the next slide, we will look at the valuation outputs for the Greek delta. So delta measures the sensitivity of the deal relative to price changes in the underlying assets. So a delta value of 1 means that for every dollar increase in the underlying assets, the deal value increases by 1. So the chart shows the delta sensitivities of PEG and Z. So if the buyer is receiving PEG, then the deltas for PEG will be positive and vice versa for Z. So delta can be very useful for many reasons. One of these is delta is used for hedging. So hedging helps us, so having delta values helps us understand the price risk exposures, and hence practitioners can reduce the variability of their returns through hedging instruments. So an example here would be we can take a long position in Z futures, which will protect the buyer in this deal against losses from increases in Z price. And another helpful usage of delta is to monetize volatility. So again, by hedging delta, the buyer can profit from market volatility without being overly exposed to underlying price changes. So an example would be the purchase of options and hedging their delta counterparts. This allows traders to profit from increases in the time value of these options. So in the next slide, we will look at the valuation outputs in terms of the deal value distribution. So again, from running, this is a histogram of 1,000 simulations. And on the x-axis, we have the deal average unit value. And so the distribution we observe here is rather symmetric and normal. And this matches with our mean value of 4.06 euros. And so this distribution is really helpful for understanding the potential upside and downside risks of our deal. So again, combining with the points from before, if the trader wishes to hedge or include hedging instruments as part of the deal, this can reduce the downside risk. So this will skew the graph to the right. Or the trader may wish to introduce extra optionalities in the deal. And these extra optionalities will increase the extrinsic value of the deal and thus shift the distribution further to the right. So there are a lot of thoughts and methods that the market participant can include in the deal to be able to shift or produce distributions in their favor. So to summarize, we covered a simple A to B transport deal. And in the next section, Chris will go over a more complex deal to cover deliveries into multiple regions.
Okay, Ying, thank you very much indeed. That was excellent. Okay, so yeah, as Ying said, we started with a simple example, A to B through one pipeline deal. We're going to now take that up a slight notch by looking at a multi-regional deal, which is based off of something called Area D. So, so the area known as Area D is highlighted by the red circle in my diagram here. It's an area in the middle of the North Sea where there's a large number of gas fields and interconnected pipelines. So Gasco, the operators of Area D, and the owners of the fields essentially sell Area D gas, even though it comes from a number of different fields. And these contracts look at the option to take gas out of the pipelines south of the red circle. So as Martin said, the UK, France, Germany, Belgium, and the Netherlands. Typically, the owner of the contracts take the gas and sell into 5 different markets, ones that have been described so far in the market background: NBP, PEG, THE, TTF, and Z. So these kinds of structured contracts exist to allow the choice of which markets to send the gas to. So there are a number of different contracts that could trade based in Area D. We've created a reasonably typical structure for this example, where the owner will pay the average of the 5 markets that the gas can go to and receive the highest of the 5 markets after transportation costs. Again, if the payoff is greater than 0. So we assume here in this analysis that transportation costs to all markets is again €5.5 per megawatt hour, the same as the point-to-point example. But in reality, these could and would be different for each destination. So similar to the example that Ying talked about, we've got a 1-year contract from the 1st of October 2022 through to the 30th of September 2023, and we take as the valuation date the 1st of September, and the payoff is represented by the equation at the bottom. We look at the difference between the maximum of the 5 regions in the analysis minus the average, taking into account the transportation costs. All right, so we're standing on the 1st of September. We've got a contract that essentially starts on the 1st of October and goes through to the end of the next September. So from a valuation perspective, we need a couple of things. We need to know what the underlying forward curve or curves are that we're interested in, and what are the model parameters that we want to associate with the various risk factors that we're going to model, and the payoff. So the payoff is on the bottom of the previous slide. So these are the futures curves observed on the 1st of September 2022. So the different lines there, dark blue is NBP, red is TTF, green is PEG, etc. These are the forward curves. So the x-axis down the bottom here is the maturity of the contracts. We've got monthly contracts going out to September 2023, all of them in euros per megawatt hour. So our risk factors here, I'm going to do the same as Ying did essentially, which is to say one way of doing it is to model the outrights directly, which is this slide, and the next slide is essentially creating a synthetic spread risk factor and modeling that. So if we're modeling the outrights, what we call the outright model here, then we have 5 risk factors. We're going to simulate NBP, TTF, Z, PEG, and THE. We're going to start with the forward curves on the previous slide. And what we've done here is we've used the data set that Martin was looking at. Here, the plot was only over 1 year, but we've used 5 years worth of data. And for each of them, We are going to model them. Again, this is a choice that the user can make. We do this to make things simple. We're going to model each risk factor as a single factor mean reverting model, where we assume a flat spot volatility for each market based off the 5-year historical returns, and we will link them via correlation. So we've used those 5-year historical returns to calculate correlations. So that's going to be one model. And if we model that way, so essentially we've got this starting forward curve, we simulate mean reverting spot prices consistent with those initial forward curves, and we use those daily simulated prices to feed into the payoff. So this is an example of one simulation. So in the distribution that we look at the end, we build it up over 1,000 simulations. This is simulation number 1. Now this time period is actually, this is a 5-year simulation, because we started off with a 5-year deal before we simplified it down, but this is a 5-year simulation, one sample simulation out of 1,000. And under this simulation, the gas would flow to the dot with the lighter blue line there, I think, which is THE for most of the period. Occasionally, the gas would flow to PEG or Z, depending on which is the highest price. But the methodology is to run these simulations and then use them to feed through into the payoff. So that's one method. So we have the 5 initial forward curves, we calibrate 5 individual models, we link them via correlation, and then we simulate what we call the outright prices. And then, as Ying alluded to, we simulate a spread model. So here the spread model is slightly more complicated than the spread that we looked at previously. So for this risk factor, we're simulating one risk factor, which is the spread, and we create a synthetic time series of that risk factor. So the graph on the left-hand side show the red line over the previous 1-year period from September 21 to September 22 shows the regional max. So we simulate. So we would take the historical 5 variables and calculate the max and calculate the average, and that's the blue one. So we've got a synthetic, we can imply from that then a synthetic spread risk factor, which is over on the right hand side. So so the spread model will essentially be take the synthetic spread forward curve, calibrate a model to this right hand side data, and we'll simulate that. As Martin said in his section, this spread is driven primarily by constraints within the system and fundamentals. You can see that for the vast majority of this period over the last year, that spread has been pretty boring, close to 0, with the spread occasionally widening to 4 or 5 euros. But obviously post-Ukraine, this has obviously changed. And as Martin described, pipelines are full, storage is full, no flex in the system. And so there's no natural sinks to control these spreads. Right, so so if we were to simulate the outrights directly, then the top right-hand side is an example of one simulation of those 5, the spreads coming from those 5 markets. But if we were to simulate the spread directly, so here we created a synthetic spread curve from the 5 individual spread curves and the average. We created this synthetic implied forward curve, and here we simulated the bottom right hand side is some simulations of the spread, calibrating the model to the historical data series that we were looking at before. Now, if we do that, we generate 1,000 simulations. Again, you can do it either way, outrights or via the spread. The analysis that we show here is in terms of the spread. Then this is the results that we get for this. Again, as in Ying's example, these are normalized prices of euros per megawatt hour. This is the daily average value, and we've got the intrinsic value from the forward spread curve, taking into account the 5.5 euros per megawatt hour transportation costs. The extra intrinsic value of 2.6 euros per megawatt hour gives us a total normalized price of just over 8 euros per megawatt hour. Again, this is the average daily value. So if we wanted to turn this into a cash value for 1,000 megawatt hour contract, then we multiply this price by 365 and 1,000. That'll give us just over 3 million euros total cash value. Again, we've done this via simulation, so we run 1,000 simulations. We can build up a distribution. That total is the mean of this distribution. But you can see here we've got a long right-hand tail going up to over 50 odd euros per megawatt hour. All right, so hopefully that gives you a bit of a flavour of sort of taking, handling sort of simple transportation A to B, what's involved with that, what kind of analysis you can run, what kind of results you get, what kind of hedges that you get out of that, and then extending it to a more complex multi-regional deal. We based it off of a sort of a somewhat typical Area D type contract to run through what are the complications you have to solve in terms of the modelling framework and the payoff, etc. But once you understand how you can model different variables, how you calibrate them and model them, there's a fairly straightforward exercise to feed through excuse me, into the valuation piece. All right, so we've got a few minutes for Q&A before I sign off at the end. Martin, I don't know if you've been monitoring the questions while I've been finishing off the last few slides.
I have, Chris. There's quite a few that's come through. Let me ask you one first. So, Chris, given the changing nature of the spreads, kind of what's a reasonable time frame of historical data to use for the calibration period?
Yeah, that question probably comes up with everything anytime you talk about valuation. And I always start with saying that calibration is obviously part art, part science. The science is you've got a set of data, you've got a stochastic differential equation, you can discretize it up, throw the data at it, and you get calibration numbers back. So, but obviously, if the market's changing, now one answer is, well, the more data you take, the more statistically accurate it should be. But if the market's changing, then if you're using data from a year ago or even 6 months ago back, then the market is very different today. So you have to make judgment calls. And obviously, everything that we do is forward looking. We've got a valuation date today and a deal that doesn't mature until 1 year in 1 year's time. So you've got to make judgments about what happens in the future. Now, that is either taking historical data and saying, well, I'm going to throw away everything that's more than 6 months old because I don't think it's relevant to today. Or I think that, yes, it's become very volatile, but it's going to settle down. So I need to take in a bit of period where it's settled down. Or if there are some implied metrics there, so if you're modeling outrights and you've got options on those outrights, then there's the market expectation about what the volatilities are going to be over that forward-looking period. So there's never a simple answer there. That's where the secret sauce comes in from a trading perspective, is what's the view about the levels of markets, when we typically rely on forward curves, or what's the volatility about volatilities and the correlations between markets.
Thank you, Chris. We did have another one. This one I think is probably best for Ying, talking about transport and usage costs. So the question is, can you model transport usage costs as variables, risk factors in your model? It is fixed in your example.
Thanks, Martin. Yeah, the answer is yes. So we've kept the usage and transport cost as a constant in our example for clarity, but in our models, we can actually create transport usage cost as a separate risk factor, and we will model it in a very similar fashion as we did with Z and PEG in my example. So we can use historical data, or we can construct our own forward curve. And using these calibrations, we can introduce that as part of the valuation, and even running some Greek values on top of that as well. So yes.
All right, let me pick one for you, Martin. There's a few here that are sort of all linked and come from a more sort of trading perspective. What do you see about what's happening to spreads in the future? Which markets will have the most volatile spreads? I guess if you knew the answers to these questions, we'd be on our yachts in the Bahamas. But I mean, what's your view of? It's obviously changed a lot from those very flat spread times to much more volatile spreads. Do you have any insights as to, from your conversations with traders, what's happening in the future?
Yeah, I think when we're looking at spreads, really what we've seen is, as I was saying, it's where you're hitting constraints. So it's where things are very near to capacity, where you've got these flexibility sinks like storage, swing contracts, power plants, where everything is near max or near minimum. That is where things move really rapidly. So markets on where we're seeing that happening, I think the UK is kind of continuing with its kind of disconnection. You usually see a bit more LNG demand through Q1 going into the UK. But I think we're going to see continuing dislocation in these markets as long as the pipeline capacities between the markets are nearly full. The Netherlands and Germany is an interesting one. That might be one to watch because that market has remained very close, so it might be worth looking there to see if there's the potential for that market to dislocate.
All right, I probably should have said we'll be on our yachts in Area D rather than on our yachts in the North Sea. So, okay, now we've gone. We'll need to try and stick this to 45 minutes. So we've obviously gone over that. So I think I should sum up here. Thank you very much, Martin and Ying. Thank you to EEX for the opportunity to present in this forum. Thanks to all the participants for your attendance and attention today. We had over 70 odd participants, which is fantastic. There are some questions we didn't get around to. If they've got names attached to them, we'll address those questions individually. But if you have any further questions outside of this webinar, then let us know what they are and we'll get back to you. One final plug, all the analysis that we've seen today and in all of our webinars actually is performed by our own tools. This particular analysis was using tools in our Lacima Trader simulation and pricer libraries. If you'd like to understand more about our solutions, how they can be used to value complex deals like this, transportation, swing, structured LNG deals, or perform risk analysis on portfolios of those contracts, then please reach out to one of our two London-based representatives. So Ivan and Stephen, the contact details are on this slide. I'll be happy to talk to you. If you're an EEX member, we know that there's a lot of EEX members have tuned in today, then please feel free to involve your key account managers in any conversations jointly with ourselves and the key account managers. If you'd like a copy of the slides, let us know, or let your account manager know. We're happy to send you a copy of the slides. And like the other webinars, they within 2 or 3 days typically, they're posted on the EXTV channel on YouTube. So again, thank you very much. Good morning if you're in Europe. Good afternoon if you're in Asia. Evening if you're here in Australia. Thank you very much indeed.